Happy Friday, everybody. Chris Magnotti, your lender for all over Colorado, feeling super summery here on a beautiful Friday afternoon. Coming to deliver some good news. Now, we've been loaded up with bad news in the mortgage industry lately, so I'm going to try and bring some good news to you. But if you recall from my video 2 days ago, we had a nasty inflation report where inflation came in worse than the market expected, showed inflation going up, and as a result, mortgage interest rates jumped. Right now, they're about 7.3%. That's the national average, 20% down. We'll always have options that beat that national average. But we also saw the 10-year Treasury spike up over 4.5% as well. And why that is very, very important is the 10-year Treasury is highly correlated with mortgage interest rates. Whatever the 10-year Treasury does, mortgage interest rates tend to do the exact same thing. And here's where the good news comes in. So we hit 4.5% again on a 10-year Treasury. Well, last time we hit 4.5% on the 10-year Treasury, September and October of this last year, well, we had mortgage interest rates over 7.5. They're actually about 7.62. So, like I said, they're 7.3 right now, which is an improvement of 30 basis points in what's called the spread, which is the distance between the 10-year Treasury and the mortgage rates. So, historically, that spread is right around 2% or 200 basis points. Well, if that was the case right now, we would already have 6.5% interest rates. So that spread can continue to improve. So even though we got those nasty inflation reports that push that 10-year Treasury up, our spreads are improving, and I do expect that to continue. There's something called a statistical reversion to the mean. I'm not going to get into it right now, but over time, those spreads will correct themselves. And the Federal Reserve is starting to make some comments about the unwinding of the balance sheet. So remember, these interest rates are fake right now. They should be much better than they are, but they're manipulated because the government, the Federal Reserve, is letting $60 billion a month run off their balance sheet in treasuries and $35 billion a month in mortgage-backed securities. So this is artificially pushing rates high. And now they're talking about how soon they're going to be reducing that. So that's going to make a huge difference for what we see in our mortgage interest rates going forward, as unwinding that kind of money into the market has had a real negative impact on our mortgage rates. So I know it's been bad news, but there is lots of sign of hope for good interest rates, and what the Federal Reserve would say is soon. Now, what does that mean? I don't know, but hopefully, it means that we start to see something change here within the next 1 to 2 Fed meetings. Thanks for taking the time to watch this video. If you like the video, click like. If you have questions about financing a home, give us a call. If you like my shirt, click like. Happy Friday.